Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to that consumer confidence number. Super strong, coming in at 103.3. The estimate was for 100.7. It's a better view of the economy and inflation, it looks like. So we wanted to go right to the source here. Stephanie Gouchard is senior economist at Global Indicators at the Conference Board, joining us. Stephanie, what led the optimism?
Well, so let me get this straight. It's an improvement, but I wouldn't qualify it as a strong improvement. The index is still in this narrow range where it has been for the past 2 years. So that's the first thing I wanted to say. But if we go into the improvement, so what has been driving the improvement is some more positive views by consumers about business conditions right now and business condition in the future. So this is really what has driven the improvement in August.
And looking at the measure of expectations for the next 6 months, it looks like the increase, so that's at an 82.5 from an 81.1, similar increase relative to present conditions. Kind of how do you view the consumer right now, given, 6 months from now, we could have 3, 4, 5, 6 interest rate cuts and an election in the rearview mirror?
So consumer feelings about the economy are really mixed. So yes, their views about business condition improve, but at the same time, if you look into the details, they are getting more concerned about employment, both currently and in the future. So this is it's really a mixed view about the economy. They are still concerned about high prices. At the same time, their inflation expectations have declined. They're expecting rate cuts more than they were a month ago. So some things are moving on the positive side and some things are moving on the less positive side, especially regarding employment.
All right. We really appreciate you breaking that down and, putting it all into perspective for us, particularly the jobs part. It feels like that's very much what the Fed's also worried about. Stephanie Gouchard, senior economist, Global Indicators at the Conference Board. It's interesting. It's like the Fed seems to be pivoting to be worrying about jobs, and it looks like that is very similar now to how consumers are feeling.
Yeah, and it does make sense, as she put it, that it's kind of mixed read, and that's why the S&P is still down 0.1%. I mean, sure, it's summer Friday vibes on a Tuesday, but
we're taking it in stride. It is my Friday, so it is definitely Friday vibes for me.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to some of the market moves here. Supermicrocomputer shares just tumbling like crazy today. This is after Hindenburg Research said it's short the maker of server equipment. We want to get more on this with Woo Jin Ho, Bloomberg Intelligence, a senior technology analyst. Did you read, what did you make of the report? It said it was glaring accounting red flags, evidence of undisclosed related party transactions, sanctions, and export control failures and customer issues. Yikes.
Yes. There was a lot in there. I'm actually glad they cited our report.
From the terminal. I didn't know that one. Okay.
Look, a lot of the stuff that we've, what I've read, they're known issues, right? They've been in the 10K and the 10Q filings as part of the risk and disclosures. They cited the delisting back in 2019. They also cited related party issues as well, and these are all known. I almost get a sense that they're trying to kick a dog while the dog is down. A short report because they had gross margin issues because of some aggressive pricing and supply chain issues. So, I do question the timing of this report.
Yeah, just keeping in mind, Supermicro from July 12th down more than 40%. But my question automatically goes to, there's a difference between known issues and issues that people actually factor into their valuation or their expectations. Like, does Hindenburg releasing this report, in your view, make analysts maybe revisit the bear case?
And that's a great question, Bailey. And I do think so, right? Because there were some, questions in terms of who they were selling to, in terms of sanction-related parties, the Russia in particular, and that's going to raise yellow flags or red flags to the U.S. government, right? And if that's going to draw greater scrutiny, you never know what might be behind that closet.
So you said that they cited your research. What else did you guys pick out from like the 10K and stuff in terms of the risks for Supermicro?
Yeah, look, one of the things that I picked out was the related parties, right? Two of their suppliers, the CEOs of two of the suppliers are the CEO brothers of the Supermicro CEO, right?
Oh.
And that's something that I'm not thrilled about. Quite frankly, you would like a little bit of diversity in terms of the supply chain versus some of the nepotistic relationship. And, that's the big glaring one, but also they've had accounting issues in the past which prompted the delisting. The hope is that with the CFO that they have currently, they've cleaned all of that mess up.
Well, because it feels like in Supermicro, obviously everyone knows NVIDIA, but this is a stock that from over 3 years is up 1,500%, went from 1.6 billion to a peak at 58 billion. Like when these companies go from small cap to large cap, it feels like, and correct me if I'm wrong, it feels like investors sometimes gloss over diving into disclosures and just kind of take them as a component of the S&P 500 and let that be their investment thesis.
Well, let me take that a step further. When you go for a management team from a small cap management team to an S&P 500 listed company, you're still in your preteen years, and all of a sudden you have to act like a grown up. Right?
Wow, that's a brilliant analogy.
Right? So when you have to act like a grown-up, the management team have to act like a grown-up, the IR has to act a little bit more professionally, I would sense. And then, look, you have a broader range of investors that are looking at the company right now. I'm not saying that they didn't do the work, right? But there probably was some momentum in there.
Because I do want to call out, so Supermicro, 9 buys, 9 holds, 1 sell. That's 19 analysts with the biggest shops on the street covering it. You look back in 2021, 5 buys. It was Northland, Loop Capital, Susquehanna, CJS, and Vertical Group. So to your point, your management growing up, and also I imagine the street following has to get caught up to speed on a stock very quickly.
Yes, right.
And does that enable some of these things to maybe be glossed over?
And I will tell you, if I saw some of the research reports from this past earnings season after they had that gross margin, let's just say hiccup, theoretically, right? The commentary behind that was a lot more critical than somebody who may have been, let's just say, an avid supporter of Supermicro over, prior to the big AI boom.
I think the preteen adult thing is like a perfect analogy, and I think that just sums it all up. Unfair question, because I know you can't actually answer it, but how much more downside do you think that there is based on the fundamentals? Like, where's a good way to think about it?
So I'll answer it in this way.
Yes, please.
If I look at the valuation of the stock right now, right, we're talking about 0.3 times forward sales. Given the AI momentum, typically I like 1 times forward sales, but historically they've traded at 0.75 forward sales. So they're playing, they're valued at a discount to their historic valuation.
Okay, that's a great answer to that question. I love that. All right, Wooj, thanks a lot. Also good to see you in studio. I think it's been a minute. All right, Woo Jin Ho joining us from Bloomberg Intelligence. He is senior technology analyst over there, talking about that Hindenburg research report that quoted Woo Jin Ho's research in Bloomberg Intelligence. Let's not forget that. So get your information there first.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You got the equity market doing a whole lot of nothing. Volume also quite light as well. What do you do when you wind up having NVIDIA? And you also have the jobs data next Friday, and liquidity is just going to be super light at the same time. All right, let's get a professional view. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, joins us now. Kathy, you're private wealth management, right? Like you're looking for the longer term. You're not a trader. Yet how are you looking at the results on 4/20 on Wednesday afternoon when NVIDIA comes out?
Thanks for having me, Bailey. Great to be with you both. I would say, look at anytime you've got a company that has, or any sort of companies that have an edge in their industry, you have to consider that for the long term as well. So I would say in terms of, people who are holding the types of stocks that are coming out with earnings today that might have, special access to parts of the market or, like technology that other companies do not, that's important. And listen, if you own it or any company in an IRA or retirement account, it's easy to sell it and take your gains off the table because you don't have any tax consequences. You really have to think about that when you own it in an individual account. So that's something that we think about when we're thinking about our clients with their long-term view, and also how to leg out of positions as well as leg into positions.
Well, how are you positioning for and advising clients to position for this AI wave? When we look at, obviously, NVIDIA, the most important company in the US market, if not the global market, but we have Supermicro, we have ARM, we have Broadcom, you name it, that are either beneficiaries or have some exposure to a print that not only will move the stock in the market, but all of these peers.
Yeah, so for companies that I think are going to, do well for the long term and have a competitive edge, I would say holding it in retirement accounts is probably a better way to go at the moment because of the large tax implications when and if you need to take it out. You shouldn't be a trader. You shouldn't be going in and out. People don't realize what that does in terms of the tax impact and how it affects your overall profit margin. So in terms of that, yeah, I want clients to have access to AI. And it's not just the companies that are providing AI, but it's the companies that are using AI as well. Right now, the market has, had quite a run up, and we want to be more cautious. We're a little bit more underweight on equities as a whole. And we're also trying to keep people away from the quote unquote over indulging in, the top 7 or 10 stocks that are out there. But at the same time, it's very hard to do when we see some of these companies running up. So it's a balancing act, and it's important to really think about how that affects, your full portfolio and not just one part of it. I always say never put more than 5% of your assets into one holding anyway. So you want to really be sure that you're not overextended in any one stock.
So you mentioned that it's not like you were crazy invested in the equity market. What is your allocation right now?
Well, I don't take clients out of their equities that are in there for the long term unless there's a specific reason why we're doing so. So I'm typically looking for clients to have 50 to 60% in equities, to have 20% to 25% in taxable accounts, municipal bonds typically, and the balance in some sort of alternative investment. There's a lot of liquid investments, alternative investments available now to clients, and I've heard a few times today people talking about the bank stocks and banks in general. And basically, with all of the regulations that are out there, we're seeing a lot in the private market come in and take over for some of that credit access. So it's interesting too.
And when you talk about some of those alternative investments, a little bit more detail on that. Are you talking about privately funded companies investing in hedge funds? What are those opportunities like?
Different opportunities for different people, different, levels of sophistication and also of wealth. So you want to make sure that you're targeting your asset allocation and the actual implementation according to that client's particular situation. But generally speaking, I would say I'm talking about private equity, private markets, different types of private credit, and there's ways for clients. They've democratized it in a sense, alternative investments, and the industry has created investments that are now accessible to clients that were not accessible 2, 3, 4 years ago. So that's very interesting, and it's a great way for individuals to add differentiation into their portfolio, non-correlated assets, and I'm a big fan of that.
When you take a look at what the Fed will or won't do you care in your investor allocation whether it's 25 or 50 in September, whether it's 75 or 100 this year, or is the moment for you just when they start doing it?
No, I care ahead of the game. Okay. I think that perception is really baked into the numbers. And if you don't start making some moves ahead of the decisions, you'll probably miss out on a big opportunity. And for example, municipal bonds still look really attractive right here. At some point, they're going to become less and less attractive as those rate cuts start to happen. So for clients with cash, I am putting them in municipal bonds, not legging in, and trying to get them in as thoughtfully and as quickly as possible, because I think that's a great opportunity for clients right now.
Do you think the market's ahead of its skis when we're looking at 6 cuts being priced in between now and March?
It's possible. It will be interesting. I think we're definitely getting cuts, this year. We are expecting cuts this year. We're expecting about 3 cuts this year. And then I would say I would just take a pause and see what's going on, the reaction, what the Fed is saying. But it is likely that we could have those cuts as well. And again, with the economic environment, political environment, everything that's going on, there's a lot at stake in terms of your personal portfolio and your individual wealth. And we really want to be mindful and thoughtful about that for clients and make sure we're addressing it and we're discussing it.
When you're talking to clients right now, what are they asking in relation to the election?
Just basically, is there a way to position the portfolio one way or another based on like what the potential outcome would be? And I think, certainly overall, clients are already invested. Like clients are invested, and we don't want to make any huge moves ahead of the election. We can make some thoughtful moves. I think minimizing tax impact for clients at any time, regardless of who is running the country or what the economic position is a great idea. So munis are a great idea right now. Using, direct indexing where you have portfolios that are trying to minimize tax impact by, sort of buying and selling and matching those off throughout the year in order to minimize gains going forward. I think that's also a great way to help clients get a little bit more alpha in their portfolio. And the last thing I would say too is there's going to potentially be some tax changes, sunsetting of some tax laws that occurred a few years ago. And if you have an estate or net worth over $5, $6, $7 million, you might want to start thinking about speaking to your estate planning attorney about some trust implementation.
And to bring it back to the equity market, since I'm a big stocks guy, that's what I do.
Yep.
I'm like talking about tax and trust implications, and you're like equities, man.
Like, what about the lines that go up and down? You talk about taking a measured approach. Are there industries, sectors that you see more kind of fairly valued, or at least more of a better buying opportunity instead of chasing some of those growthy tech names?
Yeah, I do. I think basically anytime you look at different companies, growth at a reasonable price. So you want to look at the valuations of a company and see whether or not, it's overpriced for what they're earning at the moment. But we like healthcare, we like financials, we like, consumer. So there's other areas that you can look at. I would say dividend paying, growth at a reasonable price, and income producing. It's interesting. I know you like stocks, and we all do. We love equities. We're owners, right? Not loaners. But at the end of the day, there could be some really interesting opportunities in the fixed income market as well.
All right.
Don't dismiss that.
Don't discount that. All right, Kathy, thanks a lot. We really appreciate it. Kathy Entwistle, Managing Director at Morgan Stanley Private Wealth Management, with her outlook on the markets.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the top stories of the day is also Eli Lilly now selling some Zepbound vials at a 50% discount to the shots. Michael Shaw is Bloomberg Intelligence Senior Pharma Biotech Analyst. Can we just help me understand why this is easier for Eli Lilly to produce than the actual shots?
Absolutely. So I mean, the announcement today didn't really come as a surprise on the back of the tight supply. So yeah, they're providing a vial formulation. It's something that they've talked about for a while now on their calls. Now the reason why these are easier to produce is the fill and finish capacity. So the capacity needed to actually put the drug in the pens, and the capacity needed to manufacture the pens of the subcutaneous injection. So overall, I think the move is positive for Lilly. Clearly, broadens access or patients' access to Zepbound, and also from compounding pharmacy standpoint, the fact that it improves supply means it could possibly combat competition from companies such as Hims and Hers.
Yeah, Lilly not so subtly saying that they want to aim to protect patients from, quote, counterfeit, fake, unsafe, or untested knockoffs. So how does that impact kind of the business and demand if we're seeing a cheaper version being sold and maybe trying to court some of those hims and hers GLP-1 users? How does that impact kind of the total addressable market and expectations for sales of Zepbound?
Well, I think if there's if there's a branded vial formulation out there, and there's obviously guarantees around kind of purity, etc., I think that's going to be the preferred choice. The fact that you're introducing these vials into the market would suggest that some of that supply burden and supply shortage, which is needed for a compounding pharmacy to produce a drug that is on patent, some of that will be alleviated there. So that's kind of why we think it's positive for Lilly. As to whether companies like him and hers will continue producing their versions of the GLP-1s, I mean, that remains to be seen. But I imagine if they do, Lilly will probably challenge it.
When people then do their own shots, like administer it, like is there a risk in that? Like what kind of uptake are we expecting from that? Because I would be scared to do it, but maybe that's just me.
I mean, I think judging by what we saw for uptake of these compounded drugs, there's clearly a appetite for injectable therapy, injections. Now, we look to the diabetes market, some of the insulins used to be injections. So, I mean, I think it's not, I mean, there's clearly kind of an increased kind of dosing burden associated with these injections. So they're probably not going to be suitable for all, but, I think there is going to be an appetite for it.
What does this mean for the competitive landscape? So you have Lilly, you have Novo, to your point, you have hims and hers. Like, is this going to create a pricing war, or am I reading too much into that?
No, I mean, when we look at the headline said 50%, discount. But we need to remember that, on a net price basis, so, after taking account all the rebates and discounts, the pricing is probably, fairly similar to the current net prices that we're seeing now. At the moment, it's an underpenetrated market. There's massive demand out there. There's tight supply. So I don't think it's going to change too much in terms of the dynamics between Novo and Lilly. I think prescribing decisions are less about kind of the profiles of the drug at the moment and more about what is insured, what can people get their hands on.
Yeah.
So near term, I don't see that changing. From a Lilly perspective, as they ramp up supply over the midterm of their their pens, you could potentially see patients switching from the injectable onto the pen as and when that supply comes on board.
No, fair enough. All right, Michael, thanks a lot. Really appreciate it. Michael Shaw joining us, Bloomberg Intelligence Senior Pharma Biotech Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So markets are definitely quiet. There are some catalysts, NVIDIA. We still have some data coming out. We get retail numbers from many stores coming out the next few days, and you have the jobs data next Friday. So we want to check in with Ruben Hovannessian. He's General Portfolio Manager at TCW's Fixed Income Group. Hey, Ruben, what's my position right now headed into the next week and a half?
Well, good morning, and thanks for having me on. Our position is that, I guess it's probably worth mentioning that we've seen a significant repricing in the rates markets over the last month and a half. So we've basically gone from pricing in only 2 cuts this year and a terminal rate of 3.7% in mid-2026 to pricing in about 4 cuts this year and a terminal rate of about 3% in mid-2026 in the second quarter of 2026. That's a 60-70 basis points repricing in the forward rate curve. And what we find interesting is that when you look at the credit markets and equity markets, there was some weakness in the first week of August in those markets as well, which would be consistent with that repricing. But by now, all of that weakness has been retraced. So if you look at the credit markets, for example, credit credit spreads, both IG and high yield, have retraced all the widening, and they're back to their mid-July levels or end of July levels. And if you look at equity markets, equities are retesting the all-time highs reached in mid-July. So we look at that and we think there's a little bit of a disconnect, a little bit of inconsistency. Because if you believe that the rates market has repriced because the investment community thinks the economy is weaker now, and it's going to be weaker on a go-forward basis. In fact, so much weaker that would require the Fed to intervene sooner and cut more, then you would think that some of that weakness should also be reflected in equity markets and credit markets, but we don't see that currently. So that, I guess, one reasonable one explanation for that would be that the market, or one takeaway from that is that the market has gone from pricing in no landing to pricing in some sort of a perfect soft landing. In other words, this notion that the Fed has a lot of room to cut, the Fed will be able to navigate this late cycle perfectly and calibrate the rate just right to the right level to forestall the slowing economy and at the same time not cause reacceleration of inflation. Excuse me.
And Ruben,
obviously, yes.
Were we surprised at all when we hear Jay Powell say the time has come? I mean, it seemed like maybe the expectations around Jackson Hole would be keeping, kind of giving the all clear, but maybe not necessarily signaling that we're going to have, at least as the rate market is implying, 5 or 6 straight cuts?
We at TCW were not surprised because we have been of the opinion for a long time that the economy has been slowing, although the headline numbers sometimes may not lead you to that conclusion. But when you peel off a few layers and you look under the hood, you would see slowing, labor market, for example, based on the forward-looking indicators, starting from for a year now, I guess. We have been seeing slowing of consumption for 6 months now. We've been seeing the slowing of the credit creation in the economy, and all of those were indicative of slowing economy for some time. Yet, I think I tend to agree with you that declaring a victory over inflation and telling that the time has come to shift to the second mandate of the Fed at the time when core CPI is at 3.2% and core PCE is at 2.6% indicates that they get it. They do understand that the downside risks are now real, and they have to shift and they have to act to try to arrest the declining economic growth.
All right, Ruben, we're going to leave it there. Thank you so much, Ruben Hovnessian, a general portfolio manager with TCW's fixed income group. And just to point out, we get the 2-year auction today coming at $68 billion. Then we get a 5-year for $70 billion, 7-year and $44 billion. So lots of ways to kind of wager on the Fed and supply over the next couple days as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele here alongside Bailey Lipschultz. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. So Paul's not here, so we can talk about shopping. I love shopping. I love shopping on sales. I will only shop on sales. I will only pay full price for face care, Birkenstocks, and Bionics because I have to.
Birkenstocks.
I have bad feet.
Oh, well,
so I don't have a choice.
Yeah, that's not really discretionary spending at that point.
It's not. I can wear heels or Birkenstocks or Bionics. That's it. John Tucker has things to say.
These personal details you don't really have to tell everybody about.
Do I?
But I'm glad you did.
No, come on. I love it. Didn't you talk about the whole fan and ice thing, or was that in commercial break?
I think there was a commercial break.
Excellent. Okay. That's a different story. I've had to cool your home without an air conditioner. Anyway, wanted to get an expert on this because I'm personally interested in what the sales are going to be like for the summer, which just begs the question how much our luxury and other goods and other stores have to cut prices to get consumers in the store when they really are trying to slice and dice where their spending is. So Rania Sedholm is managing partner at Sedholm Law Group. She joins us now. The Law Group provides the ability to immediately access counsel to provide practical solutions on critical issues for all kinds of companies, particularly though most of their clients tend to be in fashion, luxury goods, technology, and food and beverage. It's good to have you in the studio. Thank you so much for joining us.
Thank you.
So what's the common question you're getting right now?
Everyone is asking, when is the economy going to improve and how can I mitigate any risks? Because people are afraid they're going to have to file for bankruptcy.
Wow. Okay, so it's that bad for some of these guys that bankruptcy is on
It is. I mean, retail is hurting. If you just walk down the street, most people are walking around without bags. There's a lot of window shopping, or whatever it's called when you enter and don't buy, other kinds of shopping. But buying is on hold, and I think consumers are being pickier because they don't have as much disposable income.
And we've been tracking and talking to economists about the K-shaped recovery post-pandemic, so people who are affluent can still buy whatever they want, and others are having to seek deals. How does that impact potential clients or companies that could be going bankrupt? Is that kind of skewing more towards the middle of the road? Those are the companies that are worse off?
I think so, yes. You know, it's very dangerous in the middle. Those who are catering to the 1% or the 0.1% generally are fine. Like Hermes and Chanel and those brands, and those who are catering to people with no disposable income that sell food or things like that are generally okay because you have to eat. But when you're going into the mid-market and trying to get Henry's or, you know, middle class, whether it's middle class or upper middle class, it's very, very difficult.
So what's the strategy before we get to bankruptcy here? Because that's where the price cuts come into play, right? Can they cut enough to get enough consumers in the stores to buy enough to make up for the revenue loss from the margin cut?
Well, it's been working for Target. You know, okay. Target cut about 1,500 of their goods by substantial amounts, you know, over 20%. And I think they just reported earlier this week, or maybe last week. Last week, yeah, because it's only...
It blends.
Yeah, it's only Tuesday, yes. That they're up, finally. And they have a better forecast for the remainder of the year. So it does seem to be working for them. Whether it's working for luxury brands, it's too soon to say. But, you know, Burberry and YSL, for example, Saint Laurent, they've cut their prices, I would say, by at least 10% on many products. And I don't know yet whether it's going to help them.
Just going to ask the dumb question as someone who does not buy a lot of nice goods. Does 10% really move the kind of people who would be buying a $400 belt off the sidelines to buy one?
It certainly can, because the 10% also reduces your tax in New York, right? So we're spending, what, 8 or 9%? So 10% reduction is more than a 10% reduction in a way. So yes, it can move the needle.
It wouldn't move my needle.
Well, but I guess I'm just thinking from my perspective.
But I'm not their customer, to begin with. But you know, I like sales like, you know, 50%. Like 10% ain't gonna cut it.
That's why I ask, because like Macy's had underwhelming results. If I go to Macy's, I immediately go to the sale section, and if it's 20%, to me, I'm like skeptical. So I think they aren't actually giving me a deal. But if you give me 50 or 75% off, like the last shirt in my size, then I'm gonna buy it.
Yes, well, this is the issue, right? These are the questions we're constantly discussing. At what point do the consumers think you're going to keep reducing your prices and wait and not purchase? You know, it's not holiday season yet. When holiday season comes around, people will be buying. What it is they're going to be buying, we're going to find out. But you do have to ask yourself, how many cuts do you need? Is it better to keep cutting a little bit at a time? You know, sort of like the Fed with interest rates, a quarter point at a time, a teaser, or is it better to just cut the price? But these price cuts that we're discussing today, they're permanent. They're not on sale. These are the new prices that you will be paying. So when you walk into these stores, when it's on sale, it should be even lower.
Well, that's interesting. To Bailey's point earlier, does any of this, do you expect M&A? And where?
Yeah, that's a great question. I think that if you're in a niche market, your product is niche or your messaging is niche, you'll likely get picked up in M&A. But otherwise, no, I think it's more, you know, cannibalization and, you know, Darwinism.
But with the niche guys, aren't the niche guys doing okay because for the fact that they're niche, or it just still depends?
No, it depends, because the niche brands typically don't sell high volume. And so their cost of goods is high. And they can't manipulate their pricing as much as larger corporations can.
Well, you mentioned Target cutting prices and that bringing in consumers through the door. We spoke with Brooke Sutherland about a story on commercial real estate and pointing out that fast food chains are being able to kind of weather different trends from a return to office, whereas maybe a mom and pop shop can't handle that as well. With Target cutting prices and drawing in consumers, and seemingly more people going to stores like Walmart or a Costco or a Sam's Club, how does that impact some of these other either small businesses or even just less global retailers?
I think it's tough out there, and I think it's going to get tougher. And unfortunately, where we stand right now, the economy is so uncertain because we don't know who the next president will be. And once we do know that, people can start planning. This is probably the worst time, typically, in any election year because there's so much uncertainty. And this election in particular, we have two candidates who are on complete opposite sides of the economic spectrum. And so we are in a wait and see holding pattern, and that makes everything a lot more difficult.
You mentioned Target. What other companies do you think have been doing the price cutting and managing this environment well?
Certainly IKEA. I mean, they not only cut their prices, you can go online and you can see the price before and the price now. So they're really speaking to consumers and showing them, you no longer have to pay, I'll make these numbers up, $300 for this lamp. You can pay, $225, and this is our permanent new price. So I think they're doing a great job in showing the consumers exactly what it is they're doing to help them and drive their own sales, of course.
About 10 seconds. If we're shopping, should we be going to the stores now or waiting for some of those holiday sales?
That's such a tough question. I mean, I try not to buy things at full price if I can help it. So I, confession, usually wait for sales. But if you need something, try to go to those stores that have already reduced their prices.
Yeah, she sees me. She sees me. She gets me. All right, thanks. I really appreciate Rania Sedhom, managing partner at Sedhom Law Group, joining us there. Are you done, Bailey, with your home furnishing? I mean, it's been a year.
It's never ending. Well, because we got married, so we had to plan the wedding, and then we're still, as JT knows, trying to address a leaky roof fireplace, so the living room still
I'm not helping.
Oh, yeah, he's not helping. He already said that.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.